So my total portfolio solution is currently 3 independent tactical strategies. The defensive rotation strategy that I'm showing you today is 1/3 of that portfolio. It's a tactical rotation strategy, which means it's rules-based and it's going to be allocated to different asset classes depending on the current market environment. How it works is I'm able to priority rank all the important volatility metrics, and then we only allocate capital to the asset class that has the highest probability of success, given the current market environment. Now, the heart of the strategy is equities-based, and anytime volatility is in what we consider mid to low levels, basically stable markets, we'll be holding the NASDAQ index in the form of the 2x leveraged ETF called QLD. These are only the most advantageous days during stable markets, and that's very important. Aside from a quick drop and then a fast recovery after COVID, it has actually been a very long bull market. And a lot of investors have forgotten just how bad things can get when you're holding stocks. This is the 2x leveraged QLD during the financial crisis in 2008. And that's an 84% drawdown you're looking at, and it took over 5 years to recover and finally clear the previous high from 2007. That's what happens when investors don't have an effective trading system for drawdown reduction. So when volatility starts to get elevated, we rotate out of stocks completely and we move into the XLU, which is a utilities ETF. Utilities perform much better than the stock market during times of elevated risk and uncertainty. It's just a safety position, but it's extremely important for the overall strategy to have an exit plan before the real trouble arises. At some point, there's going to be another financial crisis. And that's where this next position comes in, because on about 8% of trading days with the most extreme high volatility readings, during those times when the market is crashing, we move entirely to cash and wait safely on the sidelines. We've got to move to full cash during those larger market drawdowns. Now, sometimes they bounce back pretty quickly, but like I said, there's going to be a time in the future when it really doesn't. And that's when our safety positions really pay off for us by avoiding the worst of the crisis. Remember, during the next recession, it's not going to be surprising at all to see the NASDAQ index drop 70 or 80%. And it could take 5 or 10 years to recover after that. So this is why we take our safety positions seriously.